Hello everybody, welcome to Talk About Houses. I'm Todd.
I'm Juana.
Today's video is about the housing market and why home prices are not likely to fall anytime soon. Also, the real reason behind why the housing market is just on fire. Okay, so we're going to start with a slide.
Yes.
Because you guys like slides. This is housing news from Surefire. It's some quantitative numbers. You know, we've been talking in the past about institutional investors. And we did have some numbers in the 3 to 5 billion range of individual funds that have raised money, Wall Street funds. But now we have a number of 89 billion. And it says large investors have increased cash flow to devote to housing, having accumulated 89 billion for building or buying rental homes. So this is a double whammy because they're either going to build them or they're going to buy them. So if they build them, they may be building existing.
Right.
Like new home subdivisions that are coming up.
Yeah.
So how does this, like, what's the effect on this? Because this is a new thing in the market. This is a new thing that wasn't going on 10, 20, 30 years ago in this magnitude.
Right. So, you know, look, institutional investors have a lot of money that they have to put to work. They can't just hang on to the cash because, as we know, through inflation, cash devalues. And they look for places to allocate that cash to where they can protect it from inflation and they can get it to grow. Real estate is one of those avenues, and they are putting $89 billion to work in that sector. That's a huge amount of money, and that is money that is going toward purchasing and or building, renovating, whatever, these homes. Now, these people are going to be in some cases competing directly with your regular owner-occupant or your regular mom-and-pop investor for properties, and that again is putting upward pressure on prices, but it's also supporting prices because as this money is being spent on these homes, these people are not going, or these institutions are not going to as readily go to sell these properties if the market changes direction.
Okay, so the money has to go somewhere. There's money to be allocated. So what options do they have? They could probably buy stocks.
They could, but remember, stocks are just another investment sector. And these funds or institutional investors, they need to balance their portfolios in order to make sure that their overall portfolio doesn't go down in a market downturn. So that's why part of their portfolio is dedicated toward real estate. They used to put it in REITs, but REITs have really lost favor in the last probably decade or so, and now they're going directly to purchasing actual houses, apartment buildings, whatever buildings that they're purchasing, because they have figured out that there's actually more money that way, and their investment is actually in a solid asset as opposed to something that is more transient, like a stock. And housing takes a longer time to turn one way or another, whether it's going up or it's going down. Generally speaking, those have much longer cycles.
Juana was talking about REITs, and keep in mind that REITs were very popular back in the 80s, but they were not specifically rental houses. REIT portfolios were somewhat diverse. They did include a lot of commercial. They would go by hospitals or apartment buildings or commercial space, things like that. And this is specifically different. They are only targeting one asset, one part of real estate. They're targeting single-family homes for the most part, and condos.
Right. So they're targeting structures that people will occupy as rentals. So these are residences. These are not necessarily commercial or anything like that. These are places that you and I live in.
So one of the things, and the reason why I'm bringing this up is because a lot of people out there are looking at what happened in the past and saying, well, prices went up, it has to go down, that's going to happen again. Well, first of all, prices have been going up in real estate since, Adam and Eve, okay? And there was a crash, the previous crash that we had over a decade ago. But this didn't exist back then. You did not have, yes, at the bottom, BlackRock came in and bought a substantial number of homes, which is probably, I think they spent about $1 billion. But that's nothing compared to 89 billion. So this is a new thing added on. Remember, all other things being equal, we talk about this all the time. This is not a thing that's equal. The other interesting thing about this, okay, let's say you're watching this video, you've got a rental house, you're thinking of buying a rental house, you're gonna go buy one house. So you're gonna go into the market, probably most likely through an MLS or using agents. You're gonna go find it, identify a property, look at how much rental comps are. You're gonna make a decision to purchase that house as a rental. And then at some point in your life, you'll decide to move out of real estate, or just, you're tired of collecting rent, doing all that stuff. You'll just say, I'll just want to take my cash out. You'll put it back into the MLS. Well, these Wall Street funds are not going to do that. Meaning, if I have a portfolio of $5 billion of real estate across the country, and I want to switch some of those, like I need to change that from 5 billion to 3 billion allocation because I'm too much real estate. I want to get in some other asset classes, right? Maybe stock market gets really cheap and they say, hey, let's go back into stocks. They're not going to dump $2 billion worth of houses on the market because it takes too long. What they're going to do is they're going to call up their buddy at Goldman Sachs or at some venture fund or at some other type of entity, hedge fund, and say, hey, look, we've got $2 billion of real estate we need to move. Can you guys syndicate this, put this together in a package? We're just going to transfer it over to you. So what happens is that Wall Street guys make a deal, these just like they did with mortgage loans, right? They just sell it, they transfer cash, they send over a thing saying you own these properties, but they never hit the MLS, so they never get transacted. So the tenant in the house doesn't even realize that it's a new owner. And these things just got bought and sold outside the MLS. And because of that, your list of available properties, what looks like it's on the market, is really not on the market. Okay. Now, obviously, things can change if they all just decide to sell them and no other institutional investor would buy. But even with that, it's pretty expensive to do that because now you're talking about tens of thousands of houses all over the country. For each one of these investors would have to somehow, hire agents, sell the properties.
Well, and the thing is, remember, they would not be selling, their entire portfolio in Las Vegas, for example, in one shot. They would be selling a few homes in Las Vegas, a few homes in Phoenix, a few homes in Miami, a few homes in Atlanta, a few homes in Charleston. It would be all over the country. So it would not actually impact any of those markets because they're not going to go ahead and trash their own market. That doesn't make any sense. These are not people who are unaware of what inventory levels do to home prices. They're very aware of that, and they will take appropriate action to make sure that they are protecting their investment and that they're protecting what the price at which they're going to be able to sell these homes.
This Wall Street activity in the housing market is unprecedented. I told you I would not use that word anymore, but we're using it. It is unprecedented. This is a new thing to the market. It completely changes the underlying base of how we view the real estate markets and these price increases and stuff. Don't believe me? Look at Canada. Canada is so far ahead of us in this because so many investors have come into Canada to purchase that Canada has actually put a 2-year ban on foreign investors. Home prices are up about 50% in the last 2 years in Canada. It's pretty crazy there. There are some loopholes because you could basically partner. If you're in Asia, you could go partner with a Canadian citizen and buy the houses. They could be the operating partner, and they have a small percentage. And you could form a Canadian LLC. There's loopholes to that. It may or may not work. What's interesting is it may send a signal, and then those investors may come into the U.S., which is going to exacerbate that problem. But you can see the countries are starting to do this thing. It could happen here. But the problem here is it doesn't really matter because there's so much money in the U.S. on Wall Street that are purchasing. Housing inventory is up 8.3% since a seasonal low in March, which is normal.
Normal. Springtime is selling season.
Okay. This is the really interesting one. Inventory remains 65.1% lower than the same week in 2020.
So an 8% increase versus 65% below. Those are some big numbers of low inventory. The thing that I think everybody needs to keep in mind is that with so many institutional investors in the marketplace, the actual value of the homes is it's really not known, because what you're looking at is just really the value of the homes, of the onesies and twosies that are selling, right? The regular people like us who have a house to sell or have a rental house to sell. But when you consider the portion of the market, which isn't that great right now, it's in the single digits that these institutional investors have, but you're not really seeing the value of those homes, because when they're being transacted off market, then you're not really getting a fair sense of what the value really is. So are they paying a premium? So because they don't have to go out and aggregate this whole portfolio when they're purchasing a portfolio, what does that really look like? That we don't know. And I think that's going to be really interesting to look at as this whole new market of institutional sellers and institutional owners exists.
Most of you know the iBuyers. They're companies like Zillow, who is not doing it anymore because they were losing money. Open Door, OfferPad. These are these companies that come in and buy the house. They're only 1% of the market in the U.S., right? They're a very small. But remember, they're just a flipper. They don't actually hold them as rentals. They just buy them and then they put them back in the MLS and sell them. So it's just like, it's not really, doesn't change the system very much. What's really changing the system is you have this number of potential homes on a market, right? All the inventory. And that growing number of homes that institutional investors are taking, so that the actual number of homes that can actually be transacted is actually declining every year. So what we're seeing is we're potentially getting ourselves into a new type of reality where in the future, there will always be less inventory because you have less people that can make the decision to sell. Because you have institutional investors that own all these properties. So now we're going to talk about the people who have been rooting for the housing market to crash because they can't wait to buy a house, but they can't afford one. So they're going to buy it on the down when it crashes, right? And one of the recent things, that the only really negative thing that's happened is interest rates are going up.
Right.
Now, people are, oh my gosh, they're up to 5%. That's crazy. Historically, that's extremely low. Actually, if you go prior to like 2011 or 10, everything, it was always above that.
Well, and even at 5% interest with 8% inflation, you're doing great.
Okay, so we have a whole video on this, but I'm going to show you this slide. As fixed mortgage rates surge, applications for adjustable rate mortgages have increased and now make up 7.4% of total applications. ARMs were not popular a couple years ago because you didn't get enough of a interest rate difference. If you were paying 3% on a fixed and you were paying 2.87% on an ARM, you're like, why would I take the risk? I'll just lock in 3. That's historically crazy low. And remember, the last time this happened was before the last crash. But remember, interest rates were relatively high then. And these ARMs were being used because people were buying the house and then flipping it. They were using the ARM as a acquisition tool to just have low payments for the first 6 months while they either put a tenant in or sell it to the next investor. They want to have high monthly payments. They never intended to have the house for 30 years. What's interesting, though, is, as you know, an ARM can be a 3-year ARM, a 5-year ARM, a 7-year ARM. They can sort of pick what they want. These people are going to play the game because they know historically that when interest rates go up over 1.5%, they only happens for 18 months on average, and then they start coming back down. So they want to get in on the housing market. They're going to start using these mortgage process, new tools, new opportunities to get in, and here we are. The market is adjusting to interest rates rising. People are still, it's not the dampening effect we need.
No, but look, people are using this for 2 reasons. Like you said, one, because they expect interest rates to go down at some point during their refinance term with these ARMs. And then the other reason why they're using them is because they're using them as a mitigating factor against interest rates going up and prices going up. So they're trying to make their payments more affordable. They're trying to deal with having to come up with extra cash out of pocket to pay the difference between purchase price and appraised value and all these other things. So this is a tool to help people get into a house today in the hope that they'll be able to refinance down the road, or that when they sell the house, maybe they're not going to be in the house that long and the house will have appreciated and it'll all be good.
Market forces are very strong, and you can't just, pick one thing and compare it to something that happened in the past, because things change. And this is a major change. Now, you're probably saying, okay, so let's say all these people rush out and they get these 3-year ARMs. And then in 3 years, they have to, something has to happen. They have to either refi or the rate goes up. And let's say we do end up, when no kidding, like 3 years of high inflation and high interest rates. Okay, what do these people do? Well, first of all, if it's high inflation, that means the home prices are still going up. So they will have equity. So if they bought the house for $400,000, it's now worth $550, and their payment just went up, $600 a month. They can say, hey, this is a little too much to pay for this. I think I'll sell the house, and they've got $150,000 of equity. So they don't really care that interest rates go up because they're sitting on equity.
Right.
So that's sort of and the other thing is, well, let's say that it's a really lousy economy for the next 3 years, and then we get back to where we were in 2006, where there's this huge amount of inventory where people can't buy because interest rates. So there's two things here. First of all, that's 3 years from now. So remember the videos from 2020, 2021, and this year, the housing market's crashing. It's crashing any day. It's going to crash. We said it was going to crash last year, but now this year, we're sure it's going to crash. And of course, every chief economist at every bank, including like the lowest appreciation rate I've seen from anybody, I think it was Bank of America, said their low end appreciation was 5%. And everybody else is like as high as 19% appreciate. These are economists at banks trying to figure out what's going on with the housing market. So the combination of Wall Street, adjustable rate mortgages coming back to sort of beat that, the combination of inflation, which makes real estate an even better investment. Every sign, like if you have a seesaw, everything is loading up on the side of strong housing market, right?
Right.
And we are not rooting for home prices to go up, $50,000 a year, even though we have rental houses and we have a bunch of investor clients who also have rental houses and they're making a ton of money, right? Because we don't want an unhealthy market. We don't want a bubble market. No. Nobody involved in real estate wants that kind of market.
Right. But, kind of getting back to where we started at the beginning of this video, the chances of a bubble market get lower and lower as there are less homes available on the market to transact. And the more these institutional hedge funds, programs and entities purchase these homes are not going to turn on the same schedule as homes that are owned by mom and pop investor or by owner occupants. Because remember, owner occupants right now are they used to turn homes every 5 to 7 years. They're not turning homes about every 10 years. So this is what we're dealing with. We don't know, because these hedge funds have not been doing it that long, we don't know what their turn times are. We don't know how they're going to turn them. We suspect that their turns will not impact the market because they will simply trade amongst themselves, and these homes will never see the market available for individuals. But so there's a lot going on in this market. And to Todd's point, you can't look at the past to predict the future because our present is so different than anything in the past.
Yeah, it's definitely, there's, another word I hate, paradigm, but this is a new paradigm. And Juan is exactly right that, if there ended up, let's imagine that there's this parallel universe, okay? And COVID happened and the economy went into the toilet, and all of a sudden there's a ton of people trying to sell homes, and there's this huge number of homes that are on the market, and then now we're to a bubble. So it's a parallel universe. Government is now incentivized to try to fix this. So what do? One of two things. They either go to the banks, like they basically did. It was too late, but they did this the last housing crash. They went to the banks and said, hey guys, you need to fix this. You can't just mass foreclose. We need to put some safeguards in here. You have to offer all these other programs, right? You know what the other thing they would do? They would actually say, we're going to use government money, we're going to buy all the houses that are on the market. We'll just buy them, acquire them, and we'll turn them into government housing. Government-owned homes, we don't really have a lot of that in the U.S., despite what you might think. Most homes, by far, huge, over 90% are just privately owned by people.
Right.
So we have these things that if we do get to a bubble, or we do get to where there's crazy inventory, we see these things happening, we have government, which hopefully has learned from what happened 15 years ago, to step in and go, we're going to make sure this doesn't happen again. And we've all we do is take data and try to say what it means.
Right. We're just trying to make sense of these things. And to Todd's point, as far as the government is concerned, they to some extent did that during the real estate crash, because when the homes were foreclosed, Fannie and Freddie had a lot of these homes, and what they did with them is they didn't just turn around and put them on the market to sell. They went ahead and they renovated them. Almost all of them were renovated. So they took a product that nobody wanted because it couldn't be sold as a short sale for whatever reason, and they made it ready for the market in a way that it attracted owner occupants. They preferenced owner occupants. So government does have some experience with how to deal with these single family homes and condos and that sort of thing, as to how to bring them back to market and how to rehabilitate the market with them.
This 89 billion number is probably going to grow.
Yes.
That's just what's currently known and available. The multiples on the stock market right now are still really high. Crypto is still an extremely new and volatile asset. You're gonna see maybe 5% of portfolios have some type of cryptocurrency, NFT, or other Web 3.0 asset in them. But real estate is right now is appearing to be very favored. If you look at other markets, like take Vancouver, Canada, I think median homes there are like $1 million. It's basically like California, but for Canada. And I think that you're going to see these investors look at these outlying markets that are not, that are relatively cheaper. We did another video where we talked about where the investors are buying. And the thing on that video that's really incredible is that it's the level of investor activity has doubled in the last 5 years. So historically, you had investors that were maybe purchasing 6, 7, 8% of all homes, and now it's over 20% in some markets. Investors, and we're not just talking about mom and pop investors, although they are a large part of them. We're talking about banana fund who walks in and goes, we'll pay cash for all these houses, and the sellers go, oh, it's cash, these other people have financing offers, we'll just take the cash offer because we don't want to deal with extensions, or we have to sell this to take the money to go to the next house.
Right. Look, I don't normally make long-term predictions, but looking at this, what makes me think is that by 2030, it would not surprise me to see 5% of the real estate market that is owned by hedge funds, some sort of a large institutional investor. And we're talking nationally, not necessarily locally. So you're going to see in some places it's more, in some places it's less. But I think when you're looking at it nationally, it would not surprise me that by 2030, 5% of the homes would be owned by such institutions.
We're going to keep watching all the numbers. We've got another market update coming in a couple weeks. We've got a foreclosure update that's coming about the foreclosures here in Las Vegas. These are national numbers that we just gave you. This is for the whole country. We do understand that some of you out there are like, well, in my market blank, I'm in Miami, I'm in Chicago, and or I'm in some suburb, and things have drastically changed. And you can't one size fits all housing because the markets are substantially different. But it's like the rising tide lift all boats. When these companies come in and they're starting to buy in different markets, it does affect other markets because people move and people go to other markets because of relative price differences and things.
Absolutely. So what's going on in your market? Are there a lot of hedge funds, big institutional investors buying? What's happening in your market? Let us know in the comments. We know what's happening in our market, and we know kind of what's happening generally in the nation. But as we always say, real estate is hyper-local, so we want to know what's happening with you. We want to learn from you. So please, go ahead and leave us comments, and we'll chat with you.
All right. Thanks for tuning in, and we'll see you on the next video. Bye.
Bye.